I know you're frustrated with the stock market, just like I am. Yesterday, the Fed raised interest rates 75 basis points or 0.75%. That's the highest raise since 1994. It's actually interesting because yesterday we had a rally and the NASDAQ was up about 2.5%. And I told Discord, I said, the last time this happened, we had a 5% down day in the NASDAQ the next day. And here we go, rinse and repeat. We're doing it again. History likes to repeat itself in the stock market. Dow dropped 800 points, tech shares slide. What should we do? Should we throw in the towel and go home, or do we look for stocks that are attractive at these levels or lower? What I'm doing is I'm continuing to watch my list. What's interesting is a lot of my growth stocks that I've been buying, they're back to the same levels. They haven't gone to new lows. If they go to new lows, I add more. This video today, I'm going to focus on 7 stocks that I think are attractive here and lower. And I'm going to be focused on GARP, growth at a reasonable price. There's 7 stocks on this video, and 2 of them I actually don't own and I've never talked about on YouTube. And they're high on my watch list. So you're gonna wanna see which stocks are on this list. Stay tuned. So you may or may not have heard GARP before, growth at a reasonable price. Let's just cover what it means. It's basically combining growth investing and value investing together. So we're looking for stocks that are growing, that are outpacing growth of the market, but aren't crazy expensive. So the stocks we're gonna look at today, 6 out of 7 actually have PE ratios and attractive PE ratios at that. Overreaching goal is to avoid the extremes of either growth or value investing. This typically leads GARP investors to growth-oriented stocks that are relatively low in their PE ratio or price to earnings ratio, multiples and market conditions. So these stocks are not in any particular order, but the first one, this is a no-brainer, we gotta get out of the way. Google, Alphabet. So there's 2 types of shares. There's A shares and the C shares. I prefer GOOGL. That's A shares. You can also buy C shares, which just gets rid of the L, and it's GOOG. P ratio on this is a 19.86, has attractive growth. In fact, over 2011 to 2021, the advertising segment of Google grew at 19.1% compound annual growth rate. That's a really attractive number. It might have some impacts here with recessionary type environment, but at a 20 P ratio, the stock, the 52-week range, 2,037, so it held that 2,000 range so far, and the high on it was closer to 3,000, it was 3,030. So if this gets back to 2,000, even where it's at, 2,140, but 2,000, or if it gets under 2,000, I think this one is a no-brainer, growth at a reasonable price, Alphabet. So this one, guys, gets brought up a lot. And the thing about semiconductors, I call it the new oil, especially when we're not in a recession. In a recession, oil is oil. But you think about all the secular growth trends. When you think about AI, when you think about robotics, EV, autonomous, cloud computing, data centers, all of it requires semiconductors. On semiconductors focus more in vehicles, automotive, electric vehicles, autonomous. Their PE ratio is only a 17.8. It doesn't pay a dividend. That PEG ratio is 0.86. Anytime you get under 1, that's considered reasonably priced or maybe even undervalued. It is up 55% over the 52-week. It's a mid-cap, $25 billion stock. But check this one out. It did get down to $34.00. This was way back in 2021. And recently, it's kind of held this range. It's been a little bit lower, close to 50 bucks. I think if you can get it around 50 bucks or less, it seems pretty attractive. You've got a 17.8 PE ratio. In fact, if you look at it right now, guys, the PE ratio is actually a 16.5. So it's because it's come down. It's down 7% today. The market's kind of rolling over here. If you look at the growth on this, though, they had 31% year-over-year change this last quarter, which is pretty solid. The balance sheet on this, you can see they've got about $1.6 billion in cash. So strong balance sheet. Decent growth and not that expensive. There's a lot of semiconductors that kind of fit in that range, but check out On Semiconductor, ticker is ON. Okay, this is one that's high on my list that I want to add to my portfolio. It's trading around a 32, 33 PE ratio right now. Generac Holdings, $15 billion market cap. These guys do generators. Let me show you what they're all about. Okay, so my parents actually have one of these, so I'm familiar with it. They have residential, you can see on the left. So you've got standby, clean energy, portables, chore products. They've got solar. You can see domestic is 85%, international is 15%, so lots of room for growth. Commercial and industrial, they've got all this stuff going on over here. Essentially, when you think about how the weather's getting worse, we're getting more and more severe storms, more electricity outages, more people kind of living further off the grid or more rural. Generac is a great opportunity. There's a lot of total addressable market, and the penetration rates aren't really that high. Let me show you the penetration rates. So here's the opportunity: widespread growth potential. Total US penetration rate estimated at 5.5% end of 2021. Highest penetrated markets in the US are about 15 to 20%, but still growing. And you can see the map over here. So the darker the green is, that's the higher penetration rate. So you think of like Maine, they've got this 21.9% to 22.6% penetration rate. But some of these states in the middle here, Wyoming, South Dakota, Nebraska, Iowa, Minnesota, where they get a lot of severe weather, and some of this is even in Tornado Alley, they don't have much penetration at all, 0 to 3% where these white states are. So lots of growth in this one. Check out the stock, especially if it starts to get lower. You know, right now, you guys, it's $227 at down 8.32%. This got down on May 12th under $200. I think if it gets back under $200, I think it's an opportunity. Now, just last week, I did a video, top 3 semiconductor stocks that I'm holding long, and ACLS was on that list. And I went into maybe a 3 to 5 minute breakdown of the company. If you're interested, go check that video out. I'll put a card up above if you want to take a look. But ACLS, the thing about this, ACLS, 15.43 PE ratio. This is actually down 6.7% today. If you look at the 32-week range, it's been between $33 and $83, but it's getting back, retesting those previous lows. I think it might get below $50. If it gets below $50, I think it's an opportunity. And what's impressive about ACLS, they have a pretty low PE ratio, and this thing had 53.34% growth in this recent quarter. And you know, they're profitable, lots of great numbers. You can see the blue line. I mean, they're growing. And I think that there's still room to run with this, especially the stock is come down hard from its highs. I think it's an opportunity right here, especially again under $50, ACLS. Now this next one is a bit of a curveball, and this was also on that video I did, the top 3 semiconductor stocks, and I covered this in a little bit more detail. But this had 171% year-over-year growth in this last quarter. So it's growing really nicely. Thing about it though, it doesn't have a PE ratio yet, although they want to be profitable here in the next several quarters. In fact, by the end of this year, they projected that they would be profitable. If you watch the video on this, I did a video with the CEO on the channel. You can go check that video out. But they're trying to be profitable, growing at 171% clip. And this stock has been beaten down. It's back to $6. It was a SPAC, but for good reason. I think it, $6 and less, it's hard to beat this stock. It's more of a long-term investment. It's speculative, and it's going to be something you're going to have to hold to 2025 or beyond. They have several contracts with customers that are in Europe, and those products are being designed and built, and they're not going to start seeing numbers hit their bottom line or their top line until really 2025. So this is something you're going to hold 2025 and beyond. So it's a 3 to 5 year type holding, but I think there's a lot of opportunity. If you look at the management team, most of the management team came from Skyworks to help build that business up. And these guys, again, just like the last 2 we covered, they're focused more in that automotive space and vehicles. I think there's a huge secular growth trend when you think of just vehicles in general. They're using more and more semiconductors. So On Semiconductor is a great one, and they've got their own niche of what they're doing. You got ACLS that's doing their own niche within the equipment space, and then you've got INDI that's doing a lot when you think of radar and things like that. And again, I covered that in more detail in that last video. Now, this next one, guys, was a pandemic darling, and it might be under pressure for more time, especially if we get into a recessionary type period. But the key to remember on this is that a lot of people say that the growth has slowed down. And that's true if you're looking at comps. But look at the growth on Zoom from 2018 to 2022. So you look at revenue. This revenue is $2.65 billion in 2021 with net income of $672 million. That grew from $2.65 billion in revenue to $4 billion, $4.1 billion in revenue with net income of $1.38 billion. The PE ratio on this stock isn't that high. Let's go to Fidelity and look at it a little closer. So this PE ratio is a little higher than a couple of the others we looked at, but you have to remember, again, this is software as a service. This is SaaS. This is, not just for individuals and schools. People think of it as a pandemic play. Companies and enterprises use Zoom, okay? And this is still a very important company. I think there's a lot of growth potential over the next, 5 and 10 years. If you're willing to take a risk on this one under $100, it was $79 back in May. So who knows where this thing could go, but under $100, it's growth at a reasonable price. It's giving you decent growth. It's giving you recurring revenue, and the P ratio is in the 20. There's not much else really like it that you can buy. Of course, it has really poor sentiment right now, and it might take time to kind of prove itself. But I think as a long-term investment under $100, I think you might be happy with Zoom, ticker ZM. Now, what's cool about this 7th pick is that it's actually a DGIF stock, so a dividend growth investment required. So it has a little bit of a dividend, 0.5% dividend. This was on the Tremendous 12 as the 12th pick that I think could do very well over the next 10 years. And it's not even that expensive. What's the name of the stock? What's the name of the ticker? I'm guessing you've never heard of it before, but it's MGP Ingredients. It's a small cap. It's $2 billion, consumer staples, 18.74 in the PE ratio. And this thing actually has ran pretty hard. It's up 43% over the 52-week. It's held in pretty well. Kind of gets traded in with those consumer staples and commodities. So they're doing a little bit better, a little bit more defensive. Now, this one is one where it could have a sector rotation, could be cyclical, and you might get this one cheaper later, but I still think it's attractive at an 18.74 P ratio. I'd prefer to get this thing $80 or less if at all possible. If you want to know more about this company, go check out the Tremendous 12, and you can watch that video that kind of breaks down MGP, about a 20-minute breakdown, as well as I think the video is about 90 minutes. It breaks down 12 total stocks that I think could be 5 to 10x stocks over the next 10 years. This video was sponsored by the Motley Fool. If you want to see the best 10 stocks to buy now, check out fool.com/firedupwealth. Please subscribe to the channel. Please hit like, drop me a comment. I appreciate your time and attention. Have a great rest of your day. Take care.